What's going on, guys? It's Jordan de Jong here, and today we are going to go through the June 2020 monthly chart pack. It's a pretty interesting time in the property sector at the moment. I mean, there's a lot of bears out there that are saying the property market's still going down. There's a lot of bulls, as you would call them, or maybe not bulls, but pessimistic people about the property market, or people that are interested in the property market saying that it's going to go up. And you're seeing a lot of banks retract their statements, and instead of these sort of 30 or 20% decreases, we're sort of seeing them pull back now to sort of 5 to 10% decreases, and some are even saying that they're going to be positive. And Chris Joy is one of those people. He's saying he's out there bear hunting and waiting for the property bears to sort of come out of hide, or go back into hiding and chop them up and barbecue them up. He's calling himself the Wolverine, which is pretty funny, and it's good commentary to see out there. But everyone's got their own opinion. Everyone's sort of saying different things about the property market. I think what we're going to see today in Corelogic's chart pack review is going to be really interesting, because I think we will start to sort of see how heavily it has impacted the market. They say this sort of Corelogic data is sort of 2 months lag behind, 1 to 2 months lags behind. So I think we'll start to see some really interesting data at the moment. I don't think it's going to be reflective of what's happening right now in the market. So obviously, we're sort of seeing, ban on auctions being lifted, and more people allowed to be out and about, and open homes and all that sort of stuff. So, we're really coming out of this sort of lockdown right now. And I don't think it's going to be too reflected in the data, but hopefully we can see some. But I think what we will see is, sort of the full extent of what's happened to the property market because of coronavirus so far. So let's delve in. Corelogic monthly chart pack, same as usual. The initial page, the residential real estate market is a $7.2 trillion industry. We've still got $1.83 trillion outstanding mortgage debt. So, when you put that in retrospect and you put it together with, commercial real estate, it's a very low LVR. It's a 20 to 30% LVR nationally that we've got. So not a lot of debt there, apart from, the old wealth would have majority of that debt freehold, and the younger generation obviously are LVR'd to the eyeballs to try and get into the property sector. So although it's a low LVR, you got to sort of do the demographics on who owns what sort of debt as well. So pretty interesting, but yeah, I'd love to delve into those numbers, and I'll probably do a follow-up video on that. Stay tuned, and I'll probably release one soon if I can find some better numbers and statistics around the demographics of who owns that debt. Quarterly growth in national dwelling values slipped to just 0.6% in 3 months to May, as dwelling prices saw the first month-on-month decline since June 2019. Yep, so there we go. We're finally seeing some quarterly negativity there, and that's just because it's a quarterly, so it takes 3 months for that data to come through, and we are starting to see it. But slipped to just 0.6% in 3 months to May. So pretty interesting there. Obviously, Melbourne, as you can see, is the negative 0.8%, which is taking a lower hit, where Sydney is positive 1.1%. So pretty interesting to see the quarterly growth. Pretty interesting. But we're going to see what happens moving forward. I mean, there's no real shoot up back from the graph there. There's no real turning point at all. So still heading into negative territory. As I said at the start of this video, it's going to be delayed by quite a bit. So we might not see any sort of rebound or slant or slope to see what's happening out there right now, currently in the market. Annual growth rates understate the recent slowdown in momentum, but point out to an improving market before the onset of COVID-19. Yep, so data's delayed again, obviously. When we're looking at it at an annual perspective, the coronavirus has only been really impacting the market for the last 2-3 months, so nothing we can really see there dramatically. We can sort of see it start to drop down a little bit, but yeah, as they stated here, obviously a strong market before COVID-19, with Melbourne and Sydney driving there with 11.7% and 14.3% respectively. So big drivers are the big cities, Melbourne and Sydney. Brisbane's not far behind at 4.3%, but yeah, no real understanding there from an annual basis. Month on month, though, results over May show that declines in Sydney and Melbourne markets were led by the upper quartile in values. So essentially what we're seeing there is Melbourne's upper 75th percent quartile is negative 1.3%, and essentially that's what that's saying is sort of the more expensive properties are where we're seeing the biggest hits. And Darwin's the same at negative 1.3%, and Sydney's in the 50th quartile, or the medium quartile, that's showing the most at negative 0.6%. So yeah, essentially the upper quartile there are the more expensive properties. I was thinking about this the other day when you've got, when you think about all the people that are on JobKeeper or JobSeeker, they're getting payment benefits and they're able to afford, or just barely afford their mortgages or their rents in a lower, bracket, sort of that, 300 to 500 sort of bracket. They're still comfortable enough to pay that money back. But when you think about, maybe CEOs or bosses or directors who, were earning a substantial income before coronavirus, and maybe, have a $4,000 or $5,000 mortgage repayment every month, $6,000 to $7,000, maybe paying, the same amount in rent. And they've been hit really hard by the coronavirus. That $750 or $750 a week or whatever they get paid is not going to be able to pay for that mortgage. It's not going to be able to pay for their rents. So they're the ones who are going to be struggling the most. And I think that's what really gets reflected in this upper quartile. Because they're the ones that will, and sometimes, it's easy to think, the people earning the most amount of money are going to have the most money. They're going to have big cash buffers. They're going to be saving the most amount of money. But realistically, when you think about it, and I've heard a lot of financial advisors talk to me about this, is people who earn the most generally spend the most as well. And they don't, because they've got so much financial abundance, they don't really have that control and discipline to save money. They just presume that, big paychecks are going to come in the door every single day. And so, or every single month or whatever it may be. But essentially, some people, I've heard stories of people earning, over $1 million a year, but they've got nothing to show for it because they don't have those financial groundings of being able to save and delayed gratification and all that sort of stuff. So you can never say people that are earning the most are the safest. They could be in the worst position right now. They might have multiple of these, $2, $3, $4 million properties, renting them out. The people renting them have now left, and they've got to try and find new tenants who are also, struggling to pay for large amounts of rents, and they might be mortgaged to the eyeballs. So from my point of view, looking at the market overall and taking all sort of segments of price points, I think sort of the lower end properties under that $6,000 and $500,000 will be doing all right because they can be afford to repay, especially in the very low interest environment that we're in. But anything dramatically higher, if you're renting at a $2 million place and all of a sudden those tenants have gone through a financial hardship and they're not able to pay their mortgage back, then, there might be other people in that situation as well. And so they've dropped. They're going to a lesser costing rent, or lesser costing place to rent. And then who else is going to be your clientele? Like, who else is going to come and rent out that place? It might be, $3,000, $4,000, $5,000 a month. Like, you're going to have a lower, demographic there. And obviously there's people doing well out of all this and all that sort of stuff. But, it's not just the everyday, day-to-day people, working class people that are getting impacted. It's the big bosses and the CEOs and the directors and everything else as well who are seriously getting impacted. So, going to be interesting to see if that trend continues going forward, and what happens when JobKeeper, JobSeeker goes out the window. So the annual uplift in dwelling market values at May 2020 was high across Sydney, Melbourne, Hobart and ACT. The annual uplift in dwelling market values, so again, we're still on an annual basis here, just breaking it down to the states level. So Sydney, Melbourne, Hobart and ACT have seen a pretty high, market uplift. And on an annualized basis, that's just saying that before COVID, we were in a pretty strong market. The rolling 28 days in the daily home index combined capital. So we've seen that come down. It's gone below the 0%. It went below the 0% probably early May, or sort of mid-April to May. And now we're at negative 0.5%. And we have seen a bit of a bounce back here though. And if you're a fan of Christopher Joy, he's actively out there saying, 2 positive days of growth, we're on the way back, but I'm coming for you bears. And I think, although you can't take 2 days of growth as, a clear indication that the market's going back up, it is good. It is green shoots. It's good to see a bit of an indication of some positivity. It's not just falling to the depths. So I do think he has a good point there. The script says, Corelogic Daily Home Value Index showed a change of pace halfway through March. Data to the 4th of June shows the combined capital cities declined by 0.5% in the past 28 days. Yep, so still on a decline there, but as I said, last couple of days has shown a bit of a positive upkick, so good to see. Quarterly and annual change in dwelling values in Sydney. So Sydney dwelling values fell by -4% in May, so not a huge drop there. Dwelling values increased 1.1% in the quarter. So although we're seeing a negativity in May, we're actually seeing an increase in the quarter overall. So when you think about we've been in COVID since March, so that is a decent quarter, and we're still seeing values increase. So although recently we have seen a bit of a drop down, it's still pretty solid. City dwelling values are up 14.3% in the past year. So, strong market before COVID. And city dwelling values are -2.7% below the record high, which was in July 2017. So, they're still only -2.7% below the record high. Sorry. Quarterly and annual change in dwelling values in Melbourne. So Melbourne dwelling values fell by 0.9% in May, so a bit of a bigger hit than Sydney. Dwelling values fell 0.8% in the quarter, so we're seeing negative territory in the quarter now for Melbourne. Melbourne dwelling values are up by 11.7% in the past year, and Melbourne dwelling values are -1.2% from the record high, which was in March 2020. So just off the top of that record high now, and a negative 0.9% in 1 month. -1% in 1 month is pretty substantial when you think about, property prices have increased on average by 6.7% annually over the last 30 years. 1% in 1 month is pretty heavy. If we stayed on this trend, we'd be sort of, -10, 11% for the year. But obviously seeing some green shoots on the daily basis, and we might not keep on that trend all the way through. But if you annualize that, it is a big percent of a proportion. So a bit of a decline there in Melbourne. But obviously, there's submarkets within submarkets within submarkets, and Melbourne is just one big market, and you can't really correlate that to a submarket. So quarterly and annual change in dwelling values. Brisbane dwelling values fell by -1% in May. Dwelling values increased by 0.8% in the quarter. Brisbane dwelling values are up by 4.3% in the past year, and Brisbane dwelling values are now -0.1 below the record high, which was in April 2020. So they had a record high literally halfway through this quarter, at the start of this quarter in April. The dwelling values are up 4.3% in the past year, so not too bad. Dwelling values increased 0.8% in the quarter, but fell in May, but only by -0.1%. So not a massive fall there at all, still being impacted in some way, shape or form, but we're still seeing an increase for the quarter. Adelaide values increased 0.4% in May. Dwelling values increased 1.1% in the quarter. Adelaide dwelling values are up by 1.8% in the past year, and Adelaide dwelling values are currently at a record high. So Adelaide property prices in the middle of the coronavirus, or pretty much at the sort of coming out of the coronavirus, are at a record high. Now, if I saw every market's different, but I kind of see that and see people saying that the property market's going to fall by 30%, and Adelaide's still at a record high and has held strong over the last couple of months. It's hard to see. It's hard for me to see. I understand demographics. I understand the economy. I understand that's happened in other economies in other countries. But from a fundamental standpoint of Australians love their own piece of land in their backyard, I can't see it when you look at that sort of statistics. Quarterly and annual change in values in Perth. Perth dwelling values are down -0.6% in May. Now, this is quite interesting because Perth have been on a pretty big rebound since about, June, July 19. So they are sort of seeing a bit of a slowdown now, and obviously that's from the coronavirus, but dwelling values have increased 0.1% in the quarter, so a pretty flat quarter. Perth dwelling values are down -2.1% in the past year. That's pretty interesting because we have seen a big rebound from them. So they're down in the year still, and they started to decline sort of May 18. They started to go on a bit of a decline, went down to negative. They lost about 10% in May, between May 18 and May 19, they lost 10%, and then they've come back up. Or maybe not 10%, maybe 8%, but they've come up now, another 8% again, pretty dramatically, but obviously still down. They must have come up 6% because they're still down 2.1%. So yeah, still down for the year, but not looking too bad, it can be completely honest. Quarterly and annual change in Hobart. So Hobart dwelling values increased 0.8% in May. Dwelling values increased 0.5% in the quarter. Hobart dwelling values are up by 6.2% in the past year. So standard year for Hobart there. When you think about 6.7% annual, Hobart dwelling values are currently at a record high. So again, Hobart's at a record high in the offset of the coronavirus. So that's why people single out sort of Melbourne and Sydney markets, because they're the ones that are sort of, have the bigger hits. But even Hobart went crazy, in May 17 to May 18. And although we have seen that come off quite dramatically, it hasn't gone into negative territory. The growth sort of slowed down to sort of, 4%, but the growth went up to about, even 15% at its peak, so sort of 15% at its peak. But the growth's only come down to about 4%, but not in negative territory. And they're currently at a record high. So very strong Hobart market there. Quarterly and annual change in Darwin. Darwin dwelling values fell by negative 1.6% in May. Dwelling values increased 2.1% in the quarter, so still a strong quarter. Darwin dwelling values are down by negative 2.6% in the past year, so a pretty slow year. And Darwin dwelling values are negative 31.3% below the record high, which was in May 2014. So way off the record high, relatively flat year, relatively flat quarter, and a bit of negative growth in the month there. ACT dwelling values increased 0.5% in May. Dwelling values were up 1.2% in the quarter. ACT dwelling values were up by 5.1% in the past year, and the ACT dwelling market is currently at a record high. So interesting to see there. They've increased a little bit, pretty stagnant throughout the month. Same with the quarter. The year's, general 5% growth in the past year, and the market's at a record high there too. So, still a strong ACT market there too. All right, into the good stuff. Corelogic estimates that settled sales bounced back remarkably over May, increasing 18.5% over the month after a revised negative 32.6% fall in April. Increasing 18.5% over the month after a revised negative 32.6% fall in April. So, when you think about a V-shaped sort of recovery there, it's pretty phenomenal. The annual change in settled values, so Sydney's obviously the strongest market there at 24%, and Melbourne's to follow at 12.5%, and the other strong market there is Canberra at 17.3%. So the settled sales has bounced back quite remarkably. So although it's hard to see what causes this data, obviously the ban on auctions and all that sort of stuff has completely slowed down the market. People were just ripping their properties off the market and putting them on hold, and just pausing that sort of thing, and now we're sort of seeing it to come back up. But even to see that in May, increasing to 18.5% over the month, that's phenomenal rebound from a negative 32.6% fall in the previous month. I'd be very interested to see how June is going to look, and July, and especially all the way up until September. Looking like a bit of a V-shaped bounce back right there. Annual growth rates in rents recovered slightly in the year to May. However, rent values are still negative 0.2% lower than recent peaks in March 2020. So, although we have seen a bit of a drop in rental, and it was a pretty sharp drop, we are seeing a bit of a bounce back at the moment. And, I've read so much about how the rental market's just falling apart, and it's over. The rental market's gone. We're going to have no cash flow. People aren't going to be able to pay back. When they move to principal and interest, aren't going to be able to pay back the repayments on principal interest. They're going to struggle moving from an interest-only loan. So yeah, but we're not really seeing anything dramatically change. I mean, we're seeing it's negative 0.9% or 0.9% at the moment as an increase, but there's no negative it's like massive negative impact on the rental market. And then this is annual change, so it is probably annualized. Well, it is annualized, not probably, but it is annualized. So we can't sort of see this on a monthly level, which would be really good to see. But yeah, it's when you think about these massive falls, if you look at the big massive fall in the financial crisis, or May 2008, that was we went from 8% change down to a 1% change, so that's a 7% change, and that was over a big sort of period of time. It looks like 6 to 12 months there. When we're really only seeing a 1% change, 0.5% change. So nothing massive showing on an annualized basis, but yeah, it'd be interesting to see how this rolls out over the next couple of months. Between a mild recovery in rents and dwelling value falls, national rental yields increased 3 basis points over May. This also breaks a continued trend of record low yields across Sydney. So, interesting. Rental yields increased by 3 basis points, which is 0.03%. So a little bit of a kick up there, nothing major to report, nothing major, really realistically to look at. But obviously it's come up from 3.72%, now it's at 3.75%. So again, that just reinforces that, when you look at the rental market and what everyone's saying about it, it's really not being impacted dramatically. This is over May. It's come up a little bit. It's still flat, but it's come up a little bit. And my perception was the rental market was gone. Like I thought, we'd be copping it on the chin with being property investors, but obviously not. Days on market is increased in the 3 months to May across the capital cities, which may be a function of a weaker market conditions amid COVID-19. Yeah, so this days on market is really hard at the moment because, all of the people that had their property on the market pre-COVID-19 and freaked out and decided to pull their property off the market or keep it on the market, whether they did or they didn't, it's still on listing websites, it's still, in all these places, it's still in real estate offices. So technically it's still on the market, but the market was on hold completely. So I don't think this is really reflecting how big that data is going to impact. But yeah, it's showing what it is showing is that before COVID-19 it did come down significantly. I think we will see that kick up pretty not massively, but I think days on market will sort of show that slowdown in during the COVID period if we're putting a month or two on top, which is 60 days. It just depends how agents report it, Like it's so hard to tell because some agents would pull the listings off completely. Now they're going to put them back on. So realistically, it's freshly on the market now, where theoretically it's been on the market since before COVID-19 and should be reporting that's been on the market for 90 days. So it just all comes down to how real estate agents and listing websites and people listing their properties, pull it off and on and off these listing websites and everything else. But yeah, pretty interesting. Vendor discounting across the capital also deepened in the 3 months to May, reflecting value falls over the month. Yep, so vendor discounting is how much vendors are willing to discount their property by. This essentially means that they're letting their property go for less. So if they're listed for $500,000, then they're discounting further. They might sell it for $475,000. That's what vendor discounting is. And obviously we're seeing it come down there, but nothing massively dramatic. They're in the 3 months to May, so that's they must be doing it on a quarterly basis. Oh no, it looks like they're doing it on a monthly basis there, but yeah, it's not like it's people are selling their properties at a ridiculous discount at the moment because they've got JobKeeper and JobSeeker being able to pay their mortgage for them. So pretty stagnant there, and that's what I expect to see when we hit September and JobKeeper and JobSeeker are sort of out of the picture. That's when I think we might see a bit of vendor discounting coming further down. At the 28 days ending the 31st of May, new listings had trended up from the beginning of the month. Yeah, so really insightful here to see how much of a bigger impact that sort of Easter break has had. Generally throughout the year, what we see is a big kick up at the start of the year, being, February, March, April. Then, Easter hits, then we go into winter. So we have a bit of a slowdown, and then people start listing their properties again about September, and we have a peak in the market at about November, and then obviously we slow down completely for the Christmas period. What we haven't seen is a bigger kick back up after the Easter period. We've sort of dramatically slowed down. New listings roughly at this time sit around 35,000 to 40,000 on a rolling 28-day count on a national basis, and currently we're at 25,000. So really low amounts of stock on the market compared to where we usually are at this point in the year. But we can see a bigger kicker come back up than we do have in other months. So bigger kicker, and if it stays on that trajectory, then we should be back to normal. However, there has been strong absorption of new listings by buyers, meaning total listings have continued to trend down. Yeah, so essentially with really low stock on market, and there's still a lot of buyer demand out there, and I'm really good mates with a whole bunch of buyers agents, and that's what I'm hearing from all of them. There's heaps of people out there right now that are wanting to buy property, and they're snapping up these properties and trying to find good deals. Unfortunately, there's not a mass of really good quality stock on the market right now, so when a really good property does come up, it gets taken up like that. And so what this is reflecting, though, is the total amount of listings is pretty stagnant, because there's still demand out there. There's still people buying property. So as properties come onto the market, they get sold off from the buyers that have the demand for these properties. So yeah, pretty interesting there to see total listings sort of relatively flat, not going drastically up or drastically down, which you'd think would go drastically down based on the current environment. The combined capital city markets have seen a year-on-year decline in total listings of 26.2%, while the combined regional areas are down 22% on the same time last year. Wow, that's a pretty big decline. I mean, if you think about that realistically, if you had 100 properties on the market, there'd now only be 74 properties. 100 properties on the market previous year, there's now only 74 properties on the market. So that's a big decline. 26% is a massive decline of listings, and there's a shortage of stock on the market right now, and that just reinforces it. So new listings changed from equivalent period last year versus the total listings changed from the equivalent period last year. Okay, cool. So new listings from the same time as last year in a regional area is down 35%. So regionally, new listings, 35% down. That's phenomenal. For the capital cities, it's 23%. Which is crazy. So not a lot of new listings compared to usual. On a national basis, it's down 28%, and for the total listings, it's down 24%. So pretty phenomenal. And the capital city is driving the total listing count, and the new listings is being driven by the regional count, which is pretty interesting to see. Clearance rates have partially recovered as restrictions on on-site auctions have been lifted. So yeah, what a V-shaped bounce back the auction clearance rate has been. When we have a complete ban on auctions, obviously it's just going to drop significantly. Obviously that tried to be rectified with online auctions and every other thing under the moon that they could find to try and do an auction, illegally or legally. But yeah, essentially we're sort of seeing that come back up now as auctions are becoming a more viable solution again. And obviously they love their street theatre and playing with people's emotions at auctions, and that's why the Melbourne market and the Sydney market are pretty much dominated by auctions, and that's why agents are pretty keen to get them back into that auction scenario. But to have a clearance rate of 61.3%, not even a month after a ban on auctions, or 2 months maximum after the ban on auctions, that's pretty phenomenal to see it come back in that light. That when you look at those numbers, and obviously people aren't doing as many auctions as they were before, and the properties probably going to auction are the ones that they know that are going to go to auction. or they know that they're probably going to sell at auction, I should say. So, you know, it might be a little bit biased there, but it's still pretty interesting to see, you know, a 61.3% clearance rate, considering the economic environment that we're in. Over May, fewer auctions were withdrawn and more vendors tested the market under normal auction conditions rather than selling prior to the auction event. Yeah, so we saw, you know, a big tick up of withdrawals and a big tick up of, you know, number of listings sold prior to auction. And for the numbers there, you know, 50% of properties were withdrawn that weekend where there was a ban on auctions, and you know, 82% of properties were sold prior to auction. Now, obviously, that all comes down to how a real estate agent reports those numbers. But yeah, essentially, the properties were still selling. They just weren't selling at auction. As you can see, by 82% of properties being sold prior to auction. But now we're back down to sort of a bit higher than usual normal levels at 37.2%. But yeah, pretty interesting to see there. Dwelling approvals, which are generally led by price signals, declined 1.8% in April in a seasonally adjusted terms. So houses and units, monthly number of dwelling approved construction nationally. So houses and units, units are down a little bit, and houses are pretty flatlined, which is pretty interesting to see from the construction industry. And the monthly dwelling approvals by state, seasonally adjusted. Tasmania's flat at 306. South Australia's ticking upwards from April to March. Is South Australia's doing well. Western Australia's coming up. Queensland's coming up. Victoria's coming up, and New South Wales is down pretty significantly. New South Wales is, you know, running at sort of 30% there, 30% less than they had. But hopefully, with the new stimulus coming out from the government and all of that sort of stuff, the construction stimulus and the renovation stimulus, I've forgotten the name of it, home builder or something like that. Hopefully that ticks off the construction industry again, which will flow into the property sector. Monthly value of new finance commitments in total in billions. So owner-occupiers are still borrowing $14.3 billion. Investors are at $5.1 billion, and we've seen a big fall down in investor financial commitments since realistically March 2017, which was triggered by the APRA intervention. Portion of new lending of investment housing excluding refinance. So yeah, big falls there. It's down to 26.2%. The average is 36.6%. So investment housing is down pretty dramatically and has been continuing to fall since 2017. New home lending amount investors fell negative 2.5% over March as a proportion of finance of investors continued to trend to a record low. So not a lot of lending for investors out there. Owner-occupier lending rose 1.2% in March, which included 2.5% lift in lending values to first home buyers. So first home buyers are the ones driving that force there. Investors are just not borrowing money at the moment, or not borrowing money like they used to, that's for sure. Over March, first home buyer participation as a portion of owner-occupiers was at its highest since January 2012. So big, strong WA drive there, first home buyers. You know, they're nearly 40% of the market, and the lowest is I think South Australia there, where they're about 20% of the market. So yeah, good to see that first home buyers are still strong. You know, all the incentives and the grants and the you know, home loan deposit scheme, 5% LVR, and you know, all of the local state grants and all that sort of stuff. It's really driving those first home buyers to get in the market, which is great to see. You know, we don't want it to be completely unaffordable that first home buyers can't get in. Over March, investor participation declined in every state except South Australia and ACT. So investor participation has declined and continued to decline since 2017. Yeah, which is pretty interesting to see. You know, in New South Wales and Victoria, we're at 29 and 26% respectively. which essentially means, only 30% of the market are investors. And this is really interesting to see. And this is why, when people are doing their due diligence, one of the things they often say is, don't buy in a market or, an area or a suburb or whatever that has more than 70% or less than 70% owner occupiers. And essentially that's reflecting this, where you don't want to buy, you don't want to buy in a building of, say 15 apartments or whatever, or 15 units, and 70% of them are investors, and so they're all being rented out, and you've got all of this competition. That's why they say stick below a 30% investor, so that you're not always competing for new rentals with all that sort of stuff. And that's kind of reflected in this data here, where it's saying investors are only 30% of the market. So you want to be below that, and if you take these as statistics, if you were investing in Northern Territory, which is the lowest one there at 14.9%, I'd be looking at investing in suburbs, areas, apartment blocks, anything that you do your other due diligence for with less than a 14% investor ratio. And even in Victoria now, I used to look for 30%, but now I'll be looking for less than 26% because you want to be below that amount. Pretty interesting. But obviously no personal financial advice there. Just something to take note of. The cash rate target was held at an effective lower bound through June, with increases in the cash rate unlikely for years to come. Well, that's a big statement there, Corelogic. Yeah. Well, obviously, Governor Lowe has said that the cash rate isn't going to go up until employment is back to 4%. I don't know if they're the exact numbers, but he did say something similar, and essentially that's what they're saying there. But no discussion of it going negative. The Governor Lowe has also said that he does not see us going into negative territory. I can't remember the exact statement, but he said it was extremely unlikely or something like that. But yeah, pretty stagnant there at 0.25%, might go to 0%. It's been a bit of chatter and talk about it. A lot of people are saying that will go negative too. So who knows? Who knows what will happen with the cash rate? Average fixed loan investor rates for new lending fell a remarkable 36 basis points from March to April. So yeah, wow. Fixed loan investor rates have fell 36 basis points. That's huge. That is huge. And what we are seeing is, this investor loan coming down pretty dramatically in line with owner occupiers, which is really great to see. Currently, investors are still 40 basis points away from an owner occupier loan, and we're seeing owner occupier loans being issued at 2.81% and investor loans being issued at 3.21%. So pretty good to see that it's coming down at the same sort of rate there. That there is talk that it will be coming down faster than owner occupier, because they're trying to incentivize investors to come into the market. But yeah, who knows? But it is good to see that it is coming down pretty dramatically with it as well. And that is it, guys. Thank you again for watching. Obviously, no financial advice here. I'm just rambling my thought process and what is going on there at the market. We are sort of seeing some of the bottom of the coronavirus, or the middle of the coronavirus, I should say, impacts on the statistics now, which is good to see. It gives us a bit of clarity on what did happen, what has happened, and what is starting to happen now that we're coming out of lockdown. We are sort of seeing some really good green shoots and some really good insights. So you could be in either camp, really. There's bearish statistics, there's bullish statistics, there's flatline statistics, there's the what if September hits and all of the stimulus comes out of the market, what happens then? So no one has a crystal ball and can tell what is happening, what is going to happen. The government can change anything at any point in time. They can put new stimulus in the market at any point in time. No one knows anything, and that's probably the one thing that I'd say to you guys coming out of this. Don't listen to me, don't listen to anyone. Make your own presumptions, make your own analysis of the market, what's happening out there, what's going on. People that I listen to is Chris Joy. He's probably the only one that's been probably the most accurate, and so if I was going to take advice from anyone, it would probably be him. And he's pretty bullish on the market, or not bullish on the market, but he's seeing an increase of 5. I think he said 0 to 5% or 0 to 10% or something like that. But he is seeing an increase. Don't know the exact numbers, so don't quote me on them. But yeah, pretty interesting times. I'm glad that we're they call us the lucky country, and we really are. We've gotten out of this pretty well. It's good to get the economy back to normal now, and hopefully this sort of stimulates everything back to how we were going and how we were beforehand. So hope you're all staying safe. Again, no financial advice. If you are looking for financial advice or personal advice, please seek your own financial advisor or a licensed professional, and they'll tailor your advice for your personal circumstances. But once again, guys, thank you very much. I'll talk to you next time. And until next time, happy house hunting. I'm always looking for more guests to come onto the show. If you're under 30 and have one or more investment properties, whether it's good, bad, or ugly, I would love to talk to you about it. Even if you're interested into getting into the property sector, let's have a chat. The main focus is to help other soon-to-be young investors with tips and tricks along the journey. Learn from the mistakes that we have made and ignite the fire to set themselves up financially for the rest of their lives. If you're interested in sharing your story, you can go to jordandejong.com/podcast, where there's a podcast inquiry button at the top that will guide you through the next steps. If you want to see what else I'm up to, you can go to YouTube and type in Jordan de Jong, where you'll find the Smashed Avo Property podcast being hosted on YouTube, and plenty of other content that I'm putting out consistently. If you're keen for more content like this, make sure you subscribe, and please leave us a review with any feedback for future podcasts. And until next time, happy house hunting.